In a previous video we have learned what this official definition of an option actually means. It talks about contracts, it talks about obligations, it talks about underlying assets, strike prices and expiry dates. If you don't understand what this all means, I can only recommend that you go back and watch that very video before you move on. Otherwise, let's go on and see how we can apply this in the financial markets. This is the share price of BHP, a large Australian mining company, over a period of 4 or 5 months, and it's currently trading, as we can see here, at about $35.50. So for some reason you think, I think this is gonna go up further in the next couple of weeks, and you're trying to make some money out of that. So the old-fashioned way would be you go and buy some shares. Call your broker, hey, I want to buy 100 shares at $35.50. That would be $3,550 for that deal, plus a little bit of brokerage. But for the examples that I give here, let's not include brokerage. You could also call your broker and say, hey, I don't want to buy shares. I just want to buy an option. I want to have the right to buy shares. Say I want to have the right to buy 100 shares. I want the right to buy them at $35.50 each. And he's going to say, yeah, that's not a problem. So how long would you like to have that right for? And you say, I want this to be valid for 1 month. He says, no problem. I can sell you an option like that. But that option is going to cost you about 50 cents per share. So in total, for the 100 shares, that's $50 now for the option. Again, if you buy the shares, you spend $3,550. For the option, you only have to pay $50. Well, similar to the deal that you struck with the umbrellas in the previous video, this option here expires in 30 days, and that is at that red line. Now, that green dotted line is an important line because you have paid 50 cents per share. So the stock price actually has to rise from where it's currently trading. It has to rise 50 cents for you to start making money, because you have the right to buy shares for $35.50. But you have already paid $50 more divided by 100 shares. Basically, the green line here is 50 cents higher. That's your break-even point. Everything up here, if the stock price goes up there, you will make money, and down there is your loss zone. This is what happened to the stock price. Look at that. Initially, it went down a little bit, but you hung in there. It went up and closed well above your break-even point. So let's have a look at the numbers. Had you bought those shares, you can now go and sell them. You own 100 shares. They are worth $37.65 each. That's $3,765. You bought them for $3,550. You subtract that. That's $215 profit. Not too bad. That's about 6% on the $3,550 that you spent. What does this look like in the options case? Let's have a look. You have the right to exercise this option. So you can buy those shares for $35.50. So you pay those $3,550. They are, however, worth $3,765, like in the other scenario. You have to subtract the $50 you paid for option, but that means you can keep the profit of $165. Now, that's not bad, because that's a 230% profit, given that you only paid $50 for the option. As a quick side note, you really don't have to worry about having to call your broker up and buying those shares and selling them. It all works very automated. As soon as an option goes past its expiry, it gets executed automatically. You don't even have to come up with the $3,550 in this case to buy the options. All you have to have, all the funds you have to have, are the $50 to buy the option in the first place. Let's do the same example again, just had we done this 1 month earlier. So this line represents today's date, and the red line is our expiry 1 month later. BHP is still trading, or is trading at $35.50, and we can buy 100 shares, as we know, for $3,550. On the other hand, we could buy an option, same deal, same strike price. That would mean we need to spend $50 for that option. Let's move towards the red line. So come expiry day, BHP is still trading at $35.50. So our shares, we can sell them. We bought them for $3,550. We can sell them for $3,550. That's break even. No profit, no loss, no problem. Let's have a look what happens with the option. Well, you can exercise your option. You have the right to buy those shares at $35.50, of course. They are worth exactly the same price. You have paid, unfortunately, $50 for the option, $50 that won't come back to you. So basically you end up with a loss of $50, or you can also call it a 100% loss of your investment. It doesn't look that good anymore. I certainly don't want to confuse anybody or add any unnecessary complications at this stage. But it's probably a good idea right now to remember what an option actually is and what right we obtain with it. Because it's the right to buy the underlying share at a specified price on or before the expiry date. We don't have to let it all go to expiry. We can certainly see that the share price moved quite favorably in the first couple of weeks, and it only came down later on. During this period, we could have made very good profits by either getting out of our option or by selling the share. We do not have to go to expiry. But this video is really more to explain the concept of options and not how to trade them or when to enter and when to exit. Let's do one more example. A little bit earlier in time, let's say we are here at the green line. 1 month later, expiry of our option is there. BHP trading at about $34.50. So you can buy 100 shares at $3,450. Well, with an option, again, pretty much the same thing. You get the right to buy them at $34.50, deal valid between the green and the red line. It's a month. It will cost you about $50. 1 month later, BHP trading at $31.40. What are we going to do? In case of the shares, well, we can sell them. Bought them for $3,450. We sell them for $3,140. That's a $310 loss. About 9% of invested money. Now, you don't have to sell the shares. You own them. You can do whatever you want to do with them. You can hang on to them, hope that they will recover. That's one of the beauties about shares. There is no deadline. On the option side, on the other hand, we have a red line here, and that's our expiry. So we could have hung in there as long as we wanted to, but the share price didn't recover. And what are we going to do? Are we going to exercise our option? Well, you can buy shares. You have the right to buy them for $3,450. They're worth $3,140. Well, you're not going to exercise. Of course not. You still paid your $50 for the option premium, and again, you lose those $50, which is 100% of the investment. But note that it's only 100% of the investment. The stock price fell way further than before, but there is not much else you can lose but the price that you paid for the option. Alright, sorry about that. I give you some terminology, and let's recap what we have just done. The type of option that we have just discussed is called a call option. It gives you the right to buy an asset. The asset that we are talking about, in this case, the BHP shares, they are called the underlying. They underlie the option. Well, for that day, I don't have any special day. That's just the day when you buy your options. It's probably today. That's about as technical as it gets. This one is an important one because that's the strike price. You obtain the right to buy the share at that price. Now you can move that up or down in your decision when you buy. We haven't discussed that yet. Don't let that confuse you. It doesn't always have to be a strike price that is exactly where the stock is trading at the moment. But the strike price is the price that you obtain the right to buy the underlying asset for. Very important. The red line is called the expiry date. Again, when you buy the option, you can also move that date around a little bit. When you buy the option, you can decide when you want it to expire. Again, we haven't discussed that, but they are not always 1 month ahead. The option price that you paid in finance is called the option premium. Remember, potential gains on a call option when you buy a call option are actually, in theory at least, unlimited, because in theory the underlying share price could just go and shoot through the roof indefinitely. So in theory your potential gains are actually unlimited if you buy a call option. Your potential losses are, however, limited because you can never lose more than the option premium that you paid. Even if BHP or your underlying company goes bankrupt the day after you bought the option, the worst case scenario, if you own a call option, is you lose the premium that you paid. You cannot lose more than that. Options expire on the expiry date here at the red line. So it's important to note that there is an expiry day looming. So you always have limited time to action and to take profits or to do something with an option. This relationship between options and time and the expiry day is a very, very important one, and we will be spending quite a lot more time learning about that.